Welcome to Module 1 of the Solus Finance course, where you're going to learn actually how the money game is played and how to understand the rules before you get involved, right? So the foundation and who controls the actual system. The people who control the system is the Fed, and they are the Federal Reserves who control the interest rates, they control the bank reserves, which we'll dive what that actually means later on in this video. But for now, just know that the Fed controls interest rates, bank reserves, they control the money supply, and act as lenders of the last resort. And like I said, we'll dive into that more later on. The government spends and the Fed manages the currency system, and commercial banks multiply the money for the Fed. So how money is actually created? Most money is not created or is not printed, right? As most people might think. So whatever you might think about money, just know that you don't know. Okay? Come into this with an open mind and try and actually learn something. So most money is not printed. It is created when banks issue loans, right? So for example, if you walk into a bank and borrow $100,000, the bank does not hand you someone else's money. What they're doing is typing numbers into your bank account, creating that $100,000, and they deposit it into your bank account. And then they record it on their assets, on their balance sheet as an asset. And so money just appeared, and this is what we kind of call credit creation, because they just created it through the loan, right? Now, fractional reserve mechanics. This is the method that banks use to be able to do this. Banks are allowed to lend multiples of their reserves, right? So, for example, you deposit $10,000 into a bank. The bank keeps a portion of that, lends the rest, and then the money gets deposited somewhere else. That bank then will turn around and lend again, right? So this expands the money supply. This is how money multiplies throughout our world, throughout our society, right? So the fractional reserve mechanics continued. Historically, banks required to hold a percentage of deposits as reserves, right? The Fed used to require banks to hold at minimum a 10% reserve requirement. So again, another example, you deposited $10,000, the bank must hold $1,000 of that, but the bank can lend $9,000. Now, like I was telling you earlier, that $9,000 is then deposited elsewhere. And then the second bank will keep 900 of that, but lend out $8,000 of that, right? And this keeps happening and happening and happening. So originally, that $10,000 that you start with ends up being worth $100,000 because it kept moving from bank to bank to bank, and the banks were just lending it out, moving it, and moving the money the right way, and allowing the money to multiply by having these interest rates and these rates on the money, allowing it to grow. So why can we not do that, right? Why the banks do it? Why can we not do that? We'll dive into that a little bit later. How it actually works today. In 2020, the Fed reduced reserve requirements to 0%. So now the banks are not required to hold a 10% minimum reserves, right? To just in case something happens, no. They're not required to hold none of that, no more. So what's limiting the lending now, right? Because it's not reserves, so it's the capital requirements, it's risk management, demand for loans, and interest rates. That's why you hear people talk about interest rates all the time and how loans aren't being paid back and the risk that banks are taking on this, that, and the third, right? So modern banking is better described as loans create deposits first. So when you walk into the bank and you ask for a loan, they're creating that deposit. And then the banks acquire reserves later if needed. So the banks, instead of having that reserve already, they wait until it's damn near too late and shit's already hit the fan to then hit the reserve and ask for money now. We'll dive into that topic later too. So now the balance sheet mechanics. Let's say you take out a $100,000 mortgage loan. right? On the bank's balance sheet, it looks like this. The $100,000 loan is an asset for them. It's then a liability deposited into your account. And then when you then take that $100,000 loan out and you move it to the seller's bank account on the property, right? Yes, it created new purchasing power, but when you pay this home seller, you deposit a transfer to their bank, and your bank may owe reserves to the seller's bank, right? So now instead of, there's also a transaction from your bank to their bank, not just between you and the seller. There's two transactions going on at the same time right here. And so banks settle using reserves held at the fund. Remember when I talked about earlier about how, let's see, I pull it right here, control bank reserves? But remember, there's no reserves. They're not required to hold reserves, right? So anyway, the reserves are like settlement between the two banks, right? That's how they pay each other. So what is actually constrains the lending is capital requirements, which banks must hold capital relative to risk-weighted assets. So it basically governed by the bank for institutional settlements, basically, making sure that banks don't go over what they can actually risk, right? So if a bank makes too many risky loans, it must raise more capital. Capital is a shareholder equity, and that's the real constraint, right? Then we have number two, interest rates. When the Fed raises rates, borrowing demand stops, loan growth slows, and money supply growth slows as well. Why? Because the money is being more expensive to get a hold of, to make, right? This is why monetary tightening works. And then number three, credit worthiness. If borrowers aren't qualified, that means they're not able to go to the bank and get loans and create more money. Now the reverse process, so the reserve process. When loans are paid back, the money just disappears. It's gone. It is vanished. But if you repay $10,000 of the principal, the bank reduces the loan asset. So $10,000, deposit liability, $10,000. The money supply contracts. Meaning, so you had the $10,000, but you paid it all back, so now it's all gone. So the credit expansion equals money creation, and the debt repayment is money destruction. So when you repay back a debt, you're destroying the money. But when you use credit to expand your money, you're creating more money, right? And this is why deleveraging cycles cause deflationary pressure. Debt is the expansion engine, right? So when money enters the economy through debt, like loans, credit cards, whatever the case may be, no no loan is no new money. But when the loan is created, that's when money is entered in the economy. And don't think of debt as a bad thing. Think of debt more of as just creating more money, right? But you are going to have the knowledge to use that debt in ways to expand the money like the banks do. The system requires borrowing to grow, economic expansion equals credit expansion, and then assets bubbles equals excess credit. When credit contracts, recessions happens. This is why 2008, the housing crash, and then 2020 when COVID hit, there was no liquidity because there was no loans and no debt being made in the economy. Now the inflation, a lot of you guys want to complain about the prices at the store, right? But you're not buying assets to fight against this inflation. So I don't know why you're complaining. But here, after you watch this video, you're gonna be like, man, I'm gonna listen to Solus and we're gonna go get some assets and fight against this inflation. So here we go. When money expands faster than goods and services, the prices rise. Right? That's inflation 101. Inflation is dilution of purchasing power. So if you just have money sitting in a checking account, right? You have $10,000 just sitting in a checking account. Every day that money just sits there and sits there and sits there and is not able to grow, inflation is eating at it, eating at every dollar that you have, and it's not able to do anything about it, right? You're allowing it to be attacked. But if you put that money into assets that then grow, each dollar then is able to grow and work against inflation, right? Inflation will still be there. You can't beat that. That's just life. It's gonna be there. But what you can do is allow your money to grow instead of having it eat away at your dollar, right? So when you put it in assets, it's they're protected by the inflation that they won't get to it. Now, here's a wealth strategy we like to take. Cash is weak long term, right? Holding too much cash is losing purchasing power, right? Yes, we love to have cash on us. Yes, we love to use cash, but long term, there's no reason to have cash on you. In today's world, cash is pointless, right? It's everywhere. And so number two is we want assets. We need assets with from credit expansion, right? So from the credit that we're making, that we're getting, we want to get real estate, stocks, build productive businesses, maybe certain commodities, and even Bitcoin is a new one, right? So then smart debt can accelerate wealth. So if you borrow at a 5% rate, your asset grows at 10% rate. There's a 5% difference in there. That's called the spread. That's how you go against the loan that you just made. You end up making money from the loan that you just borrowed. That's why I try to explain that debt can be good and can be bad, but it depends on how you use it. Now, money creation. Now, the summary of what you learned in today's video. Money is created through banks issuing loans, backed by the central bank, fueled by debt, and expanded by credit and diluted by inflation. The system isn't evil, it's just leverage based, right? So the banks have all the leverage, and they're relying on you to just sit there with your money in a bank account, which eats away at your money because of inflation and everything else that's going on, right? But once you start to allow your money to grow, you start to see it's not that bad. Now, once you understand that, you stop trying to save your way to wealth and you start building productive assets. That's what I wanted to get through today, guys. I hope you learned something from this video. If you need to, go back and rewatch it, take notes, whatever the case may be. But this is the things, and this is what you need to understand before hopping into the money game and allowing each dollar to have its own job to start producing cash flow for you guys, right? Because at the end of the day, we're all gonna die anyway, so we might as well go out and have a little bit of fun while we're doing it. As always, I'll see y'all guys in the next one, where we're going to talk about why for personal finance and income versus expenses versus cash flow and all of those things. So hope you guys enjoyed this video. Have a good one.